welcome to our talk space on mortgage. This is your host, Sarah. Today we talk about early settlement penalties. Early settlement penalties, also known as early repayment charges (ERCs), are a facet of mortgage agreements that deserve meticulous consideration. In the United Kingdom, these penalties are designed to regulate the process of repaying a mortgage before the agreed-upon term concludes. While the intention is to safeguard lenders against potential financial loss, the implications for borrowers can be This prose delves into the multifaceted aspects of early settlement penalties in UK mortgages, exploring their origins, functioning, and the implications they carry for homeowners. Deeply, the roots of early settlement penalties can be traced back to the nature of mortgage contracts. A mortgage is essentially a loan secured against a property, and its terms are agreed upon by both the borrower and the lender. Early settlement penalties were introduced to protect lenders from financial losses that might arise when borrowers decide to pay off their mortgage earlier than initially agreed. Early settlement penalties operate based on a simple premise. If a borrower decides to repay their mortgage before the agreed term, they are obligated to pay a fee to the lender. This fee is typically calculated as a percentage of the outstanding mortgage balance. The rationale behind such penalties lies in compensating the lender for the interest income they would have earned had the mortgage run its full course. While early settlement penalties serve a purpose for lenders, their implications for borrowers are a subject of debate. On one hand, these penalties can act as a deterrent, dissuading borrowers from refinancing or selling their property too soon. On the other hand, they can be perceived as a financial burden for homeowners who wish to capitalise on better mortgage deals, clear their debts faster, or sell their property due to unforeseen circumstances. The financial aspect of early settlement penalties is crucial for both lenders and borrowers. For lenders, these charges act as a safeguard against potential revenue loss, especially in a climate of fluctuating interest rates. However, borrowers may find themselves grappling with substantial fees, hindering their ability to make financially prudent decisions. The effectiveness of early settlement penalties in balancing this financial equation remains a point of contention. The landscape of mortgage lending in the UK is dynamic, influenced by economic factors, regulatory changes, and market trends. The impact of early settlement penalties can vary based on prevailing economic conditions. In a low-interest rate environment, borrowers might be more inclined to consider early repayment, potentially leading to increased penalties for lenders. Conversely, in a high-interest rate scenario, the penalties might be less pronounced. The regulatory framework surrounding early settlement penalties has evolved over the years. Regulatory bodies in the UK, such as the Financial Conduct Authority (FCA), play a crucial role in shaping the rules governing mortgage agreements. This emphasises transparency in mortgage contracts, ensuring that borrowers are adequately informed about the existence and implications of early settlement penalties. However, the effectiveness of regulations in mitigating the potential pitfalls for borrowers remains an ongoing challenge. Consumer advocacy groups have been vocal about the need for fair and transparent mortgage practices. Organisations championing consumer rights often raise concerns about the potential for exploitation through excessive early settlement penalties. Calls for clearer communication, standardised penalty structures, and caps on charges have been part of the discourse, seeking to create a more equitable balance between lenders and borrowers. But the destiny. Debate surrounding early settlement penalties has spurred innovations and alternatives within the mortgage industry. Some lenders now offer mortgages with reduced or waived early repayment charges, providing borrowers with greater flexibility. Additionally, the rise of fintech in the financial sector has introduced new models, such as peer-to-peer lending and digital mortgages, which might reshape the dynamics of early settlement penalties in the future. Early settlement penalties in UK mortgages embody a delicate balance between protecting lenders and ensuring fairness for borrowers. As the mortgage landscape continues to evolve, the discussion around the necessity, transparency, and impact of these penalties will persist. Striking the right equilibrium between financial prudence, regulatory oversight, and consumer advocacy remains imperative to foster a mortgage environment that is equitable and beneficial for all parties involved.